Good morning, everybody. Welcome, Joe. Good morning. Thanks for being on. Appreciate everybody being on this morning. So, welcome. We've got a good training today. Got Mr. Joe Geary here with the fabulous mustache. It's the fullest it's come in. It's the best it's looked, Joe.
Thank
So,
you. It's been months in the making.
yeah, it looks good. Looks real good. So, Joe started with us when he was 19. He's 26 now, correct? Yeah. So I've known Joe a long time, seen him grow up right before my very own eyes, and extremely proud of Joe and what he's accomplished. He's really jumped into the investor space, purchasing rental properties himself over the last 12 months, and he's picked up what 10 doors in the
Yep,
last
10
12 months.
doors.
Yeah, which is awesome. So really, really impressive. A lot of units. He's building a lot of passive income, a lot of wealth through owning real estate, which is something that I firmly believe in, and I think everyone should be doing in our industry. So I'm excited to have Joe on here today talking about how he's done this, and honestly, how you've done it relatively quickly. I mean, that's a lot of units. Like a lot of people set a goal to buy one a year. You've picked up 10 this year, and you've got active flips going, and you're doing it without utilizing a lot of money out of pocket, correct?
For sure. And also the big part is the time too. I'm still a full-time real estate professional, so I'm not leaving my current role for
Yeah.
investing.
Let's talk about that for a minute, Joe, because that's something I think is really important. Joe's got a good presentation he's going to pull up here in a moment. But what he's talking about there is a lot of people will, like, they have a good real estate career. Joe has a really good real estate career. I think I checked this morning. I think you've closed 38 or 39 homes this year, uh,
Yes.
which is pretty consistent. He's in the 40 home plus properties a year. What a lot happens to a lot of people is when they have a really good real estate career and then they start shifting into purchasing rental properties and doing flips, that income they're generating from the real estate career tends to suffer because they're pushing a lot of their time into this new vertical. And what happens is they start trading income. Let's just say, for conversation's sake, I'm making $100,000 as an agent. Hey, I want to go buy some rentals and start taking on flips. I start doing that, and now all of a sudden my real estate business suffers. So my real estate income drops to say 30,000, and then I pick up income on the flips, but I'm just trading income. So Joe's point there, he's continuing through time management. He's continuing to keep his real estate career going and keep his income high on this side while adding income. And that's what we want to do. We don't want to trade income. We don't want this income to drop and this income to go up. We want this income to stay the same or increase even, and this income to start growing as well. And that's how we get ahead. So just keep that in mind as he moves through this. Um, as you start doing this, if you guys, take the advice he's giving today and decide to start doing this, make sure you don't let your real estate business suffer. Keep that income up through good time management. And let's talk through it, Joe. Let's get into it. So, if anybody has questions, appreciate everybody being on this morning. If you have questions as we're moving through this, drop them in the comments. Feel free to unmute. If you're watching on Facebook, you can comment there as well. You can also click the link Leo's going to post in Facebook if you want to jump on the Zoom as well. So, Joe, anything to add before you get started?
No, no, and I'm going to dive a little bit deeper into that too, just because I think it's very important. Just because I've been in real estate for a short time compared to many other people, but I have learned that there's been a lot of agents I've worked close to or with that have done exactly what you're talking about, where they start to build their real estate sales business, and then all of a sudden they have some cash sitting on the side. They're like, "I'm going to go all in and investing," and then one flops or they both flop, and they just wasted a lot of time and experience.
Yeah, good point. And that's what you don't want to have happen. So let's do it, man. Appreciate you being here. Let's get on
Perfect.
it.
For sure. So a little bit about myself, if you don't know me, I've been an agent since 2018. In 2019, I started working lightly with investors just by a whim. I happened to have a commercial property that I was selling. I called expireds just to try to get listings. I had a commercial property. Someone wanted to buy it or look at it. Happened to be someone who flips houses. To this day, I've been working with him still, and he usually flips 5 to 6 houses a year. And then I had another situation like that where it was another commercial property. Someone wanted to look at it and they happened to be very interested in it and then ended up using me as their agent and then started flipping houses. So since I started or became an agent, I've worked with a lot of investors and kind of seen, the ups and downs, the highs, the lows, just on, people can have some massive wins and they can also have some massive losses where I've seen people have to bring money to the closing table when they, have a flip that goes wrong or a rental that goes wrong. So don't get me wrong, investing looks very sexy online. But at the end of the day, if you don't make wise, calculated, educated decisions, it can very well hurt you or put you in a tight position. So really for us, if you're a real estate agent, there's no reason you shouldn't be investing in real estate. It's almost like if you've ever played the game Monopoly, the goal is to own as much real estate or as much assets as possible. And how I see it is we're all the facilitators of the Monopoly game. Since we're real estate agents, we're helping people pick up real estate or sell their real estate and cash out on it. So if we're not investing in real estate, where's our money going? Because ultimately, if we're not putting our money into anything, we are just constantly grinding and basically being a slave to our money. And there's a lot of things that are going on right now. I'm sure everybody knows about AI, where we don't know how far AI is going to go. And if you can even put it into ChatGPT and ask them who is going to be well off in the next 5 or 10 years. And I've done this multiple times just to see how it responds. And basically, it says that the people that own the assets are going to be kind of the cream of the crop and at the top. Everybody else who doesn't have assets are going to get hurt very bad. So now is the time, especially if you've been on the sidelines, to really think about how can you continue to be an agent and also become an investor at the same time. Any questions so far? Nope. Okay, cool. So has anybody heard of Burr before or any background with Burr? Few people. So I've heard a lot about Burr before I actually started doing it, and I always was very skeptical about it because they always talked about, oh, you can, use other people's money, rehab it, and rent. And to me, just the whole fact of rehabbing a house is I'm not handy at all. If I have a leak in my sink, I usually have to call a plumber or someone that knows how to fix it. So as far as construction or doing, any type of work on a house, I have very little skill set in it. So that was a big holdback for me because I didn't know how to rehab houses. Another factor was just the financial side is being able to, risk a lot of money and then possibly not get a return. And then a lot of people you see do flips. And I know agents that do flips and some people that do flips full time. Flips can be a great way to get a mass amount of income. However, not every flip is going to go exactly the way you want it to. And the other thing is, your flip has to be perfect. It's easy to have a rental that looks nice and get somebody to commit for 12 months. But when you're flipping a home, it has to be someone committing for at least 30 years on paper with their mortgage. So it has to be perfect for someone to actually move forward and buy it. And I think it's also very important to kind of like I talked about before, I've worked with people that have hit some home runs or some grand slams with deals, and also some people who have struck out and had to bring money to the table or take a loss on a deal. So it's super important to really be able to analyze deals and then also the risk, kind of run the different contingency factors on, hey, if I buy this deal and I, rent it out for 1,500 a month and it refinances or appraises for 175, this is my cash flow. This is my equity, blah, blah, blah. And it's also good to run those numbers at 150 and at, $1,300 in rent. So it's very good to, play it best case, but I like to be very conservative when I run my numbers just because I'd rather be, surprised in a good way than surprised in a bad way when the appraisal comes in way less than what you were anticipating. So really the biggest thing, whether you're doing a flip or a rental, is how to analyze a deal. So when you're looking to do a BRRRR, which is a buy, rehab, refinance, or buy, rehab, rent, refinance, repeat. So the biggest thing when you're analyzing these deals is number one, finding out what are the comps selling for in the area. Or most of the 2 bedroom, 1 bathroom homes in a specific neighborhood that you're looking in, are they selling for 125,000? Are they selling for 150,000? So really figuring out what the homes in that area are selling for, and then what you want to do from there is you want to figure out, okay, so if I find a house, how much money do I need to put into it? So as far as financing goes, and I'll get into that in a minute, but this kind of goes hand in hand with analyzing a deal, is if you use a hard money lender, which hard money lenders are basically private people or private entities that lend out money without being beholden to government standards. They're just private, so they have a lot more flexibility than a traditional lender would, where you have to put 20% down. So with a private money lender or a hard money lender, most of those lenders are going to lend 75% of the after rehab value. So if all the, and I'll just use basic numbers to make it easy for everybody. So if all the homes are selling in a neighborhood for $100,000, and the house that I find, I think I can, fix it up and make it worth $100,000, then that hard money lender would lend $75,000 of the ARV, which is $100,000. So with that 75%, you have to use that not only for the purchase price, but also for the rehab. So if I found a house for $50,000 and I could fix it up or get it to where it needs to be to appraise for $100,000, then ideally I would want my rehab budget to be $25,000. And then at the same time, I want to calculate what is the lender going to cost or my money going to cost once I refinance this house, because you really don't want to keep your property with a hard money lender for a long time. Number one is the interest rate is very high. Sometimes you'll get 8%, some lenders will be at 12%. So, for a short time, it can be very much worth it because you're getting into an asset with very little money out of pocket. But also at the same time, you don't want to hold on to a project for 6 months or a year and be paying 12% interest only, because it's going to hurt. It's going to hurt financially if you have 5 or 6 of these projects going on at once. And ask me how I know, because I've dealt with it. So that's a big thing right there. And then, oops, let me go back. So with that being said, so you also want to make sure once you do that refinance into a 30-year conventional loan or a DSCR loan, which is a debt service coverage ratio, with those loans, I know a lot of people aren't super familiar with it, is when you have a debt service coverage ratio loan, the lender wants to make sure that you have enough rent or potential rent to be able to cover the debt on it, and then also a little bit some. So some prefer 1.20, which means whatever the rent would be, you're 20% higher with your rental income total. So if the payment and debt service on it was $1,000, they'd want to see that that property produces $1,200 total. Any questions so far?
Yeah, Joe, I've got one. How are you putting your budgets together?
So that's a very good question, because
And
when I
well, I was going to say, yeah, how are you putting them together, and has it improved since you've been buying more property?
can you hear me now?
Yeah,
Okay.
we got you.
Yep. So basically, when I bought my very first one, I had no idea what anything really costs to redo a house. So I literally just hired a general contractor and had them come in before I, got through the inspection period, and basically was like, "Hey, this is what I want to do to the house. Can you put together a budget for me and tell me exactly, what it will cost to do new flooring, paint the entire house, make it where it's going to appraise for that higher value." So that was really the first property I ever did, was solely just a general contractor coming in, bidding everything out that I needed to do to get the property to appraise for a higher value. And that's what I learned that way. And then once I got through to that first project, I was able to look at the invoice, kind of break down the costs, started going to like Home Depot, Lowe's, seeing like, hey, this luxury vinyl plank is $3 and 20 cents per square foot. This paint to paint a whole house is going to cost $1,000 or whatever. So on my second project, what I ended up doing is I kind of was the general contractor, which I don't recommend because it sucks up a whole lot of your time. But basically, I would manage, like, the people that do the flooring, the people that do the paint, the people that, fix up the outside or whatever it might be. And I was actually able to like go to Home Depot, pick out the materials, and then I was very quickly able to kind of realize like, hey, it'll cost this much to do floor. It'll cost this much to do cabinet. So really, it's just by experience on doing a lot of these deals. But for anybody new, I highly, highly, highly recommend just having a general contractor, because that will save you tremendous time. Yes, you might pay a little bit more, but it allows you to focus on what you're good at, which is selling real estate, and make sure that that faucet of income doesn't turn off or doesn't start trickling, basically.
Yeah, because that's always going to eat up the most time, like making all the trips to the store and like having to pick stuff up constantly, and it does. So I would totally agree with that, Joe. Having a general contractor, even though you're going to pay a little bit more, it's worth it from a time standpoint where you don't have to mess with all of that.
100%. Which I don't regret necessarily doing my own general contracting on two of the deals because it did teach me a lot of cost. And it also gives me the ability to know those things. So then when I have a general contractor come in and say, hey, for this flooring here at this house, I'm going to charge you $10,000. And I know well in the back of my head that I just had someone do this, same square footage on another house for $6,000. So the main benefit with doing one or two projects on your own is that you really get to be able to learn the insides of things. That way you can speak very intelligently with general contractors and make sure people don't try to screw you over in the future.
Yeah, for sure. That's awesome. A couple questions too. Melanie asked, what percentage should the mortgage be over the rent for the DSCR loan?
So most lenders, so if you do a commercial lender or a commercial bank, usually they want to see 20% over what the debt is. So kind of like I was saying, if the debt payment on it is $1,000, they want to see that the property produces $1,200. There's also a lot of DSCR lenders that don't have any debt service coverage ratio as long as the property breaks even. But at the same time, if a property is just breaking even and you're just covering the debt payment, it's probably not a deal you would want to get into because it's not going to cash flow at all.
Cool. And then Madeline asked, do you manage and run your analysis just through Excel, or do you have other systems you plug numbers into for like the rehab and the for all of it?
Yeah, so I use Excel or Google spreadsheets for a lot of my deal analysis. So usually what I try to do is I try to, look at deals on the MLS or from wholesalers or off-market connections that I have, just to see like, hey, these are, good deals for different neighborhoods versus what the average price is or average price per square foot. And then, because I don't want to walk, 50 properties every single week when I have my own real estate business going on. So I try to weed it down to maybe 3 to 5 houses to look at in one day. So then that way I'm not wasting my time and I can kind of weed out the bad ones and see like, hey, these properties are going to make the most sense for me to look at today. And then once I do that, I'll usually try to take videos or take pictures walking throughout the entire house. That way, when I go back to my computer, I can kind of sit down and be like, all right, it's going to need flooring. It's going to need paint. It's going to need a new kitchen. It's going to need, the bathroom demoed and remodeled. So whatever it might be, but that's typically how I do it is I'll put it into a spreadsheet and then also figure out what the 75% of the ARV is, what the purchase price is going to be, and what the budget will be to figure out what I need to offer for our property.
Awesome. And then Melanie's asking, are there any good banks you've had good experience with that you would recommend for new investors?
So there's a lot of like small hard money lenders out there, and they're not technically banks. They're really just like kind of entities or like LLCs or small corporations that literally just raise money from people that sometimes want to get a better return in the stock market by lending out money to people that are investing in real estate. And I can definitely share those connections, at the end of this call or once I talk about lenders more. So there's an abundance of private money or hard money lenders. And then as far as the banks goes, most lenders, not every lender, but a lot of lenders will do DSCR loans. Even if it's like your preferred lender that you usually work with, I would definitely talk to them about it because most of the time they have some sort of DSCR loan program. The one thing you do have to watch out for with DSCR loans is some of them have a prepayment penalty. So if you don't intend on holding a rental property for a long period of time, say if you sell it in the first year, some of them will be like a 3-2-1. So in the first year, if you sell it, you have to pay a 3% fee on the total loan amount. Next year is a 2% fee. Next year is a 1% fee, and then it's gone completely. But that is something to look out with the DSCR loans is that there can be a prepayment penalty on it. Any other questions?
That's it for the whoops. That's it for right now.
Perfect. So then the last part of the analysis is really figuring out what your exit strategy is on whether you're going to flip the house or you're actually going to refinance the house and hold it long term, and keep it as a rental, basically.
How are you determining that right now? Whether you're going to keep it or hold it?
So for me, the biggest way to determine it is basically if the property is going to cash flow based on the after rehab value, what the loan amount would be, what the payment would be, and then also, in some areas you can get really. So I have a project in Tower Grove South right now that I just put on the market, and if I were to rent it out, it would probably rent for around $2,000 a month. And the payment on it would be right around $1,900, maybe 2,000. So it would like barely break even. Now, some people could say, from a appreciation standpoint, that that could be a good investment to hold it long term, just barely scrape by with the, just cover the debt basically, and then, 3 years or 5 years down the road, sell it. But with me being a somewhat newer investor, my goal right now is to have cash flow on every single property.
How much cash flow are you looking for on average?
So really on average, and I know it doesn't sound like a lot to most people, at least $150 a month or more after you put money away for vacancies and money away for repairs. I want to see at least 150 per property. And usually it's going to be a lot more because on some properties you won't have any vacancies for a while or any repairs. But I think it's important to have those reserves. And if you really think about it, if you're making $150 a month on a property and you're only having to come out $5,000 or $10,000 out of pocket, it's a very good return on investment. Yes, it doesn't look like a huge number, but from a ROI perspective, it's a very high return on investment that you're not going to get anywhere by putting 20% down and finding a house that's move-in ready to rent out.
Yeah, your cash on cash return is extremely high because you're putting very little of your own money into it. So, yeah, that's awesome. And not to mention, Joe, that's just say at $150 a month right now with the 10 you've purchased, and it's 21,600 a year you're putting in cash flow in your pocket. It's 100 grand in 5 years if you continue to do this. So it's really good. You'll be 30, you'll have $100,000 in passive income. Not to mention the appreciation on it, the tax benefits and all that I'm sure you'll get into. So yeah, that's awesome, man.
Well, and the really cool thing is with every property that you do this on, you automatically have at least 20 to 25% equity in. So you're very quickly building wealth. And like you might feel like you're broke when you're in the middle of doing this, but if you look at like all the properties you acquire, all of a sudden you're like, holy cow, I just have $200,000 sitting there in equity that I have access to at any point in time. Not to mention the other strategies that, I'll get into here shortly. So, some of the benefits of being an investor and an agent at the same time is that you really understand the neighborhoods better than anybody else. So, really, just like being an agent, it's a competition. You're always going to be competing with people for a listing appointment, always going to be competing with people for a buyer. Same thing when you get into the investor world is it's a competition. People are trying to find the best deals possible, build a rental portfolio faster than everybody else. So it's a very competitive atmosphere. And I'd say, especially with us being, in the St. Louis and metropolitan area, there's a lot of people from out of state trying to get into this ecosystem as well. So it's very competitive. So being an agent puts you at the top very quickly, especially if you've been doing this for 1, 2, 3+ years. You already likely have a lot of experience with a lot of the components that go into investing. So the biggest thing is you understand neighborhoods better than anybody else. You'll see a lot of out of state investors overpay for houses in not so good neighborhoods because they didn't understand what they were buying. They saw a cheap house and they thought it was a good deal, but really all the other houses around it were very cheap too. And they can't get rid of them or they can't unload them. So that's a super important aspect that I see is that we know all of the markets for the most part better than any other investor does. The other opportunity is that you can see potential off-market deals or deals before anybody else does. I mean, how many times do people come across someone wanting to sell their grandma's house or their mom's house or, someone that passed away in the family, they just want to fire sell it super quick just to be done with it, get their cash. And how many times do we pass on those as agents and then put them on the market, get 10 offers on them and then all of a sudden it sells when you could be the one giving that person an offer and finding a great deal that's off market. So that's a huge benefit. It's just naturally by being an agent in this ecosystem, we automatically will get deals that come to us, especially if you start telling people that you're an investor, it'll just naturally come to you. And then the other thing is you can also represent yourself to save on commission. So most of the time when I'm making an offer on a property, I'll either let the listing agent or another agent represent me if they, brought me the deal just to make it more appealing to them. Or in some cases, I'll represent myself or the LLC and I'll just waive my commission completely just to be more competitive, especially if it's in a competitive situation where there's a lot of people trying to buy that house. Because ultimately, $2,500 now, yes, I'm missing out on the potential income. But if I buy a deal and I have 20 to 25% equity in it, it could be 20,000 or $25,000 that I'll be able to gain just in equity, not to mention the cash flow from it. And then you also build instant credibility with investor clients. So when you become an investor and you start doing this a little bit, even if you have one property, you'll learn a tremendous amount more than just by sitting on the sidelines analyzing deals and, reading books and watching videos and podcasts about investing. If you actually get in the weeds and start doing it, other investors at art agents will want to start working with you because they know that you have experience dealing with problems, dealing with construction, dealing with vacancies. So it really builds your credibility up and basically gives you an unlimited pipeline of investors that want to work with you because a lot of agents surprisingly don't invest in real estate and they'll say, "Hey, I work with investors all the time." But they don't know what they're doing. So a lot of times they'll give their investor client wrong guidance, and that investor, maybe a year down the road, 5 years down the road, will be like, wow, I was really misguided. I bought this house way over the value and now I'm stuck with it, or whatever the case might be.
Hey Joe, question came in from Lisa. How do you handle the accounting portion on numerous properties as far as bank accounts? Do you have separate accounts for each? Do you have one? How are you handling that
So I
with the
actually
10
talked in
properties?
pretty great detail with my accountant about this. And what he recommended was for each LLC that you have, and he recommended putting basically having like $1 million or less worth of properties in one LLC. And then if you hit like over 1 million or over 2 million, to kind of like divvy it out, just because then you have a good amount of assets in one LLC. But for to make it easier for filing purposes and tax purposes, I put all of my properties in an LLC, like one LLC for right now, or if I'm partnered with somebody else, we'll have our own LLC to put that property under. So that's kind of how I do it. And then obviously for bookkeeping, really just saving every single receipt, all of the lender, interest that you pay, closing costs, all of that can be tax deductible come tax season.
So you have one account, one LLC for the majority of your properties?
Yeah, yeah. So like
Yeah.
for all the properties I that I own individually, I have an LLC, and then if I have a partnership with someone, we have our own LLC just for those properties that we own. So I
Yeah.
put them all under one LLC just because it's a lot of tax returns if you do each one in a separate LLC, and then also at the same time, if your property is only worth $150,000 or $200,000, I mean, yes, they could go after two of those, but at the same time, it's not a huge deal. So that's kind of why my accountant advised, trying to keep it like once you get to 1 million or 2 million, that's when you might want to consider doing another one, just to keep them kind of separated and protected.
Yeah, something else I do too with mine is I have them all in one, but then I have a management company set up as well as like another level of protection. So they'd have to like sue the management company first, and then it's called like piercing the veil in a lot of regards. Like you have to have, and you can have umbrella policies also. So there's a lot of different things you can do from that standpoint. But yeah, you definitely, as you continue to build, continue talking with your accountant, with lawyers, just to make sure you're protecting yourself because lawsuits can happen and they do happen. So yeah.
Well, and I also think it's important, don't worry about that too much right now. Like if you just have one rental property, you're just looking to buy one rental property, like you'll talk to people and they're like super over analyzing, like, oh, I'm
Hmm.
going to, Bermuda and get my LLC set up there and then, have this complicated, complex system to protect myself. And it's like, you're going to waste all your time and all your money doing that and you're never going to buy a house. So like
Right.
just get started. And then like Michael said, as you grow, maybe once you get to 20 properties, 30, 40 properties, that's when you need to be more strategic because then you almost have a target on your back because people know, you have a lot of assets.
Yeah. Don't worry about the account in the Bahamas yet.
Exactly.
It comes later.
Cool. Any other questions on this topic so far?
Nothing in the chat. If you have anything, guys, feel free to unmute and ask though, or drop it in the chat. Either way.
So the biggest hurdle for most of us, or probably all of us, is taxes every single year. And I know you've mentioned this before, Michael, and this is something I've really dug deep into just because, taxes are one of our biggest expenses, especially as people being self-employed or having your own LLC or corporation, depending on how you run your business, but we still have to deal with taxes every single year. So the biggest benefit that we have as a real estate professional or being a real estate agent and an investor is we almost automatically qualify as a real estate professional status, which is something that the IRS recognizes for people that spend, I believe it's 750 hours or more per year doing real estate activities, managing their own projects, their own rentals, you automatically qualify for that professional status. So what this does is say you have a rental property and you have depreciation on any rental property that you buy, which is 27 and a half years. So you have your depreciation, you also have the interest, which is an expense, you also have your taxes, which is an expense, and you also have your repairs, which is an expense, and then any utilities that you would cover. And then also the money cost, when you acquire the property. So what would happen for a normal person who wasn't a real estate professional status is that depreciation would wipe out the cash flow, and on that cash flow, that 150 bucks or 400 bucks that you were making per month, you likely wouldn't have to pay taxes on that because it would be wiped out, and that would be the extent of the tax savings that you get. But because we're real estate agents and real estate professional status, if there's any leftover loss there, that automatically flows to your active income. So, say you made 100 grand and you have, $5,000 per property and you have 10 properties, that's $50,000 that could come off of your active income immediately just by owning rental properties. And the other huge factor, and I just learned this a couple weeks ago, is if you do flips and you're a real estate professional status, flips do not get shown as capital gains. They get shown as active income because that's just part of your job basically is that you're handling everything in a real estate ecosystem. So when you're doing flips, they can show up as active income and not capital gain income.
Which isn't positive in
Huge.
some regards, because your active income tax bracket's typically going to be higher than a capital gains tax bracket. So, right?
For sure. Yeah. And that's why you have to buy. That's why don't solely focus on flips. That's why you want to build the rentals because you can basically use the flips to fuel the rentals and kind of offset all of that money that you make from flips, basically.
Yeah, no doubt. And then have you done any cost segregation on any of your properties yet?
So I actually talked to my accountant. This was his opinion. He said he would only recommend it if it was a higher value, like if you bought an apartment complex or a
Hmm.
like a big commercial building. He said basically for a house that's like 150,000, or 200,000, it can be somewhat risky because the IRS, you're almost like throwing up a hand to the IRS and basically saying like, "Hey, I'd prefer not to pay taxes this year." And then he said they like look very closely at everything you're doing. So that's why he only recommends doing it if you're going to have like an apartment complex or a bigger asset, where it's
Hmm.
gonna, like massively save you and be worth the slight risk that it brings with it.
Okay. Yeah. So yeah, we'll get into cost segregation as well and kind of the power behind that. And we'll talk about that all later on a tax class though. But Ishan says too, what strategies do you add to your day-to-day activities specifically find investment deals, or do they just come as part of your standard activities? So you do anything out of the ordinary to go track these properties down, or are they just kind of flow into you?
So for me, and I'm probably unique from other agents, is I've been working with investors for a very long time. So I just have the habit of constantly looking in certain areas that they would buy to see if there's any good deals on the MLS. And then over time, I've built relationships with hard money lender or not hard money lenders, but with wholesalers. So what wholesalers are is they're basically people, if they're a good one at least, because there's some that try to lock up properties in the MLS and then wholesale them, and that I would never work with a wholesaler that does that. But there are good wholesalers that actually are actively looking for distressed properties. They lock the property up for a specific price, and then they'll sell it to an end buyer, which is an investor who's either going to rent it or flip it. usually with an assignment fee, or they'll up the price a little bit. So then they'll make a little bit of money for, their time and effort finding a good deal. So that can be another great way. And that's a very passive kind of way to find deals is you build a relationship with a wholesaler and you show them that like, hey, if you send me a good deal, I'm going to buy it, I'm going to close in it, no issues. Then that really helps your credibility and they'll start sending you more deals. And it's very passive that way. So leveraging hard money and contractors. So I know we talked a little bit about hard money, and some people are terrified to even touch hard money. And I actually had an investor, have an investor. He's never gotten a loan ever before in his life for any sort of real estate. He's always been cash. And I really kind of started talking to him about, hey, hard money, you don't have to have all of your money tied up in a deal all at one time. So he just recently started using hard money, and now he's scaling where he's going to be able to do 3 to 5 flips all at one time just through that leverage of using hard money and then also finding good, solid, reliable contractors or general contractors that actually show up and get jobs done on time. So leveraging hard money or private money. So the difference between hard money and private money is hard money is more a little bit more organized or an organization or LLC, where private money would be just a private individual who might have a large sum of money that wants to get a better return, where you would go directly to them. Say Michael, he's worth $200 million. You go to Michael and you're like, hey Michael, I want to buy a house. I want you to lend me, 100 grand and I'll pay you 10% back at the end when I'm all done, and it'll be backed by my real estate property. So that would be an example of a private money lender. It's just someone who has a large net worth or a lot of liquid cash that's looking to get a good return. And you very well might, everybody on here might know someone, whether it's a family member, a friend, a past client, even that has a good sum of money and wants to invest in real estate, but doesn't want to have to deal with the headaches of managing contractors, timelines, appraisals, lenders. So that can be a great way to find money as well. And then the other benefit with this too is, oops. So with the finding the money is you can also very easily find people that want to partner up with you. So once you really know how to do this at a high level and demonstrate to people that you can do this at a high level, or at least get it done quick, get a good return and not be underwater on deals, people will naturally start reaching out to you and want to partner with you because they don't know what they're doing. I mean, they could go and try to do this on their own and they might completely flop and be completely lost because there's a lot to it and it's a high pressure type situation. So if you start putting yourself out there, people will naturally gravitate towards you and say, hey Joe, I want to partner up with you. I see you just bought, 3 houses last month and I have no clue how you did that. Can you show me the way? And that's when you can start, kind of negotiating or coming to a agreement where maybe they bring up the money and you do all of the management and work a deal out somehow that way. So that can be another great way to find money to get into real estate, literally with $0 out of pocket. But at the same time, you're going to be using a lot of your time and a lot of your brain power to manage these deals and get them to the finish line. And then the other component of that, and I know we talked about it a little bit, is really being able to manage contractors. So that's something that you almost hear every investor talk about at some point. They had a bad contractor that showed up for a few days, didn't finish the job, and then they had to find someone else, or they took the money up front, they left, and they never came back. So it's really important to make sure you're vetting your contractors. And the way I've done that so far is literally letting other people vet them first, and then I come in afterwards and I use them after. So basically, I have past clients that have done flips for a while, and I've gotten to kind of see like, hey, these are good contractors over here, these are bad contractors. So I've basically let other people kind of do the vetting for me. And then I just simply reach out to those good contractors or contractors I've seen their work firsthand and then start using them to do my projects as well. So it's a super important aspect of this entire thing is if you don't have good contractors, nothing else will go right for you. So I know we touched on this at the very beginning, and it's super important. And I just want to emphasize this even more is that your sales business still comes first before all this investing. So buying the rental properties is almost like building up a 401k or a Roth IRA, except a Roth IRA or 401k is very passive. This is not passive at all. I mean, people like to say that, real estate investing is passive, but you're literally just starting a new business, but it's a long-term business that's going to pay you, in 5, 10 years. You might make some money today, but really the actual money is going to come later down the road. So you really have to still focus on your sales business because if you just focus all in on your rental properties, your income is going to completely diminish. And if you have two, three, four projects going on, your holding costs per month, and I've had some big months where I've had to, cough up $8,000 or $7,000 just for holding costs on properties, whether that's lender fees, utilities, going over budget. So you have to have your active income because if I didn't have my active income right now, I would be living under an overpass, just because it can be a lot of money that you need to spit out basically to get into these properties. And I'm not saying that to scare people, but if you're scaling this quickly and wanting to grow fast, you have to really increase your income to be able to manage the holding costs and the refinances and all the other hidden costs that could come up when you're doing this. Any questions about anything so far?
I was going to throw something out there. I think that's the big thing people miss when they start buying these investment properties is they make some assumptions. They make assumptions that one, tenants pay rent all the time, which doesn't happen. And two, like nothing's going to happen to the property. You like I know with my rentals, like every spring, I'm going to have X amount of HVAC repairs that are going to be needed, whether it's replacement or like, servicing or whatnot. Same thing in the winter. Like when heat got kicked on recently, I know there's a certain amount of those HVACs that are going to have the heat problem. So I have to be prepared for those types of bills. You also have to look at it and say, issues pop up, right? Plumbing issues pop up, things happen. So you have to have a cash reserve to be able to pay for the stuff. So if you're barely scraping enough money up to buy one, you may want to start thinking about maybe I shouldn't do this at the moment. If you don't have those reserves to pay, because to your point there, you had some months with your holding costs where you're shelling out a lot of money, and that happens with rentals too. Like you might have pick up 5 properties really quick, and then all of a sudden, four of the tenants don't pay their rent. You still have 5 payments to make though. So stuff like that does happen. Those are things to think about as you get into this. Not to scare people, but just stuff to think about as you get into this. You've got to make sure you don't let your income go and start going all in on this to where if stuff like that happens, you don't have the money to make those payments then because now you're in a really tough spot.
For sure. And that's somewhat why I like doing this is because it really like sets a fire under you to increase your income because it's kind of like a big loop. It's like, all right, I have a lot of holding costs, a lot of expenses, so I need to increase my income and I also need to increase my income so I can buy more. And then it's just like a big cycle, but it's a machine that's basically building up your future net worth and your future cash flow to really just use your real estate business to fuel your growth as far as scaling your rental portfolio goes. So flips, I wanted to touch on flips more because a lot of people just simply see flips and think they're going to be super easy. They're just going to put, you know, $30,000 into a property, put it on the market for 200,000 and make $70,000 no problem. And it usually never goes like that at all. And the other thing is people usually want to just flip a house and they're like, man, I'm about to make $30,000. I'm going to go to Mexico for 2 weeks. I'm going to buy a new car and I'm going to, go out for a steak dinner 2 nights a week. And that's just the wrong way to look at it because really what that flips is it's a big surge of income. But then if you're just spending all that money, you're really just going back to what you're doing with your agent income. Because if you're an agent right now making a good amount of income and you're not investing all of your money, you're somewhat wasting your time doing what you're doing because you're not ever going to be able to really be in a position where you don't have to work if you don't want to. And it's the exact same concept with the flip. So right now, the way I am viewing my flips is if I happen to come across an opportunity where there's a solid profit margin with a cushion, I will flip a house, but none of that money is going back into my pocket. It's literally going right back into that LLC's pocket to be able to deploy to buy more investment properties. So it's basically like rocket fuel to be able to buy as many. It's almost like at the casino where it's like it's the house's money. So you're literally just putting the house's money back into the house and building velocity with your own money. So you might only have to start this with, 10, 20, $30,000. But once you really build the velocity, you can simply just keep recycling the money to really scale quickly and at large. So I want to talk about this too, because just simply by being an investor, it automatically grows your real estate business just from all of the things that you learn from being an investor and all of the problems that you have to address. It makes being a realtor honestly quite easier, because nobody wants to show up and meet a sheriff at a house to evict a tenant when it's 30 degrees outside, which I just had to do recently. Not fun, but it's a learning experience. So doing the hard things in real estate investing make your life as a realtor a lot easier. You're like, oh, I just have to deal with this inspection notice. At least I don't have to, go to this property where a tenant had a dog and it pooped all along the basement and I had no idea they had a dog. So it really makes you have a kind of a hardened mindset to be able to deal with problems, and especially problems in our real estate business don't seem as bad once you deal with problems as a real estate investor. And then, like I mentioned earlier, you really start to attract investors who want your expertise. So, whether you have past clients or you have a new lead that comes in that wants to start investing in real estate, they're going to see you more of an expert and want to work with you versus an agent down the street that might say they work with investors but own zero properties. And you tell them, like, hey, I've built my portfolio up to 3 properties in the last 6 months. They're going to be like, wow, that's amazing. How did you do that? Can you teach me how to do that? So, you automatically just start attracting people because they want to learn how you're able to grow so fast and they want to do the same things for themselves. And the other big key component to this is once you start doing these rehabs, even if you hire a general contractor, it's super important to be walking your properties on a regular basis. You still want to go, like, even if you hire it all outsourced, you still want to go to that property or have someone go to that property for you at least once or twice a week just to make sure progress is being made and nothing's being done wrong. Because if you don't visit it for a while, they could, do the floor the completely different way than it's supposed to be. They could put the tile in the bathroom wrong, who knows what, but it's super important to visit your properties regularly. So, one thing you learn from doing that and also dealing with counties, municipalities, inspections is you're very good at dealing with buyers and sellers when it comes to inspections because you know exactly what certain things are going to cost immediately. And you also have an entire contact list of contractors that you're building while you're doing this of people that are going to be drastically cheaper than almost any contractor your seller would be able to call. Because when you're doing these rentals or these flips, you're looking for the cheapest but the best option possible. So you automatically have an entire list of contractors that you can, deploy to any of your clients that are going to do the cheapest job but the best job possible. So it adds a tremendous amount of value to all of the clients that you work with in your real estate business. And then also just by picking up those investor clients, like I had mentioned, I kind of, did it the opposite way around, where I started working with investors when I had zero investing experience myself. But these people that do buy investment properties, especially if they're serious about it, typically will do at least 3 to 5 deals per year. I have, someone who usually does at least 12 per year. So it's a great way to really build your pipeline and expand your active income just by becoming an investor. Because these investor clients, if you're doing your job properly and giving them good guidance, they should be repeat clients and coming back for more. So, it's kind of some of the final thoughts that I have, just kind of from all this, and we'll just open it up to any questions or examples that anybody wants. Is that investing accelerates wealth and skill. So, I know we talk about it in the traditional route that most people like to go is a 401k or a Roth IRA, which are great wealth vehicles. And the reason they're so good is because they're very passive, where you don't have to do anything. Like you just go on your Schwab app or wherever you use to invest and you just click a few buttons, your money's there, you don't have to think about it and you just let it ride. Where with real estate, it's the exact opposite. You have to be very much in the weeds, handling all the things, making sure, the properties are managed right, the contractors are doing their job. But the benefit with real estate is you have so many tax advantages. You have cash flow each month where, stocks might pay you dividends each year, each quarter, but real estate's going to pay you each month. You also have appreciation where, it's going to go up little by little each year. It might not, go up 10% or 11% like the stock market each year, but it's going to be a steady incline every single year. And then you also have equity, and your tenants are paying down the debt for you. So they're building your wealth every single month. And then the biggest thing too for people is if you're hesitant about getting started, is just start small. And that's exactly what I did. I started one property and that was all I focused on. I was like front of my head every single day. How do I get this property to the finish line, get it rented out, get it refinanced, and move on to the next one? So start small, but don't wait to do this because, like I talked about earlier, with AI, it's really going to create a big class divide with everybody in the world for the most part, or there's either going to be people that have the assets or there's going to be people that just simply work and don't have any assets. So now is the time to really get those assets because people are always going to need a house to live in, no matter if robots do everything, or there's AI for our jobs, even people are still going to need a house to live in. So if you can have 20, 30, 40, 50, 100 houses, people are always going to need a place to live. Whether if the government subsidizes them or people still figure out a way to pay for them, there's always opportunity with real estate because it's something that AI can't simply replace.
So, Joe, question for you. How
Yeah.
did, if somebody wanted to start today, what's the first step they take?
So I'd say the first step is really just to get structured with financing. So financing is going to be one of the most important parts is just finding money. And for anybody that wants to get started with this, I'm happy to, guide you and, make introductions for you to very good hard money lenders and commercial lenders that do this every day. But that would be the very first step. I mean, just like any buyer that we work with, the first thing we want is for them to get approved. Same thing for you is make sure you're approved. Make sure you're approved. You can look at the numbers and say, hey, this is how much I need out of pocket, or I need at closing. This is how much the holding cost is going to be each month. And that way you at least can make an informed decision. You're not just jumping in blindly and saying like, oh shoot, I need $10,000. I don't know where I'm going to get that. And that can put people in the bind. So definitely first step is to talk to a hard money lender, a private money lender, or someone who's going to partner with you to be able to figure out how you're going to finance these deals on the front end.
And then Brittany has a question for hard money lenders. Do you need the property first?
No, you do not need the property first. There's some that want you to have the property first, but if you talk to them and just kind of explain, this is the price range that I'd like to buy in, most of them can get you an approval letter. So it's basically like a normal mortgage pre-approval, except, by Geary Capital, Brittany's been approved up to $200,000 purchase price. So it's almost the exact same thing. So I recommend getting that approval letter first from that lender. That way, as soon as you find that next deal, you can jump on it immediately and don't have to worry and scurry around to find money. And you can and also prove to the seller that, hey, I'm good for it. I have the, approval for the funds to be able to close on time.
And Madeline asked, would you suggest that your first property be a rental or a flip?
Rental 100%. It's so rentals are way easier, and I didn't really talk about it in here too much, but with a rental, you can I'm not saying you're putting lipstick on a pig, but there's some things that you can keep. So if you have a rental and you have windows that are 100 years old, if they're still working, you can keep those windows. Now, if you're going to be flipping that house, a buyer's going to come in there and say, "Hey, these windows are, 100 years old. I want you to replace them and put vinyl windows in or all new windows." Same thing with like a roof. You might have a rental house that you find and the roof's 15 years old, but it's not leaking. As opposed to a flip, if it's 15 years old, people are going to come in there and say, "Oh, my insurance is going to be way higher if you don't replace this roof." So there's a lot of things that you can somewhat save money on, and I call them CapEx, which is like roof, foundation, furnace, AC, water heater, plumbing things. Those are kind of big functional items of the home that when you're looking at a rental, as long as those things are functioning, you can keep them the way they are and not have to mess with them. Versus a flip, a lot of times you're going to have to address at least one or all of those things to make it perfect for someone to be able to commit to paying a very high price or committing to a 30-year or a 15-year mortgage.
Yeah, that's great. And Kim Yetta says, my investor clients come to me all wanting 3 bedroom turnkey for Section 8. So that's something we didn't touch on really. But yeah, Section 8, I own a lot of Section 8 stuff
Yeah,
myself.
you can actually do this exact same concept with Section 8, and this is
Mhm.
beautiful for Section 8, because you're basically, fixing up the property, you're getting it to appraise for, the after rehab value, and then you can immediately rent it out to someone Section 8 and have that guaranteed, payment from the government every single month, which is a very nice peace of mind, to have that ACH payment on, on blast every single month and not have to worry
Yeah.
about stopping.
That's something we've touched on that earlier, like not earlier today, but in the in the past on Section 8. I'm a big fan of Section 8. It's guaranteed income paid by the government. So it's but and to Madeline's point too, should it be a rental or not? I think what you're alluding to there, Joe, as well, is that yeah, you kind of have a format, if you will, for rental property. So meaning that, like if I go into my rental property, I know that I'm putting carpet in most of the areas. I'm putting vinyl in the kitchen, vinyl in the bathrooms. I'm painting the walls, the ceilings, everything the same color white. I'm taking ceiling fans out. I'm putting flush mount lights in because ceiling fans will get run 24/7 and they'll break. Like there's stuff like that where you can have a formula or a format to what you do to a house. I'm making a very nice basic home, like if you will, right? It's not like this elaborate like granite and quartz and like quartzite and it's a nice, comfortable home for somebody that I have a format for it where I know exactly what I'm going to put into the property and I know what kind of rent I can get for it. And so that's the one thing too on flips, Joe. I think that I see people over improve. They do the flip not necessarily for what the market calls for, but what they would want in their property. It's like, well, I want quartzite that's going to be $17,000, where I could probably get by with granite or quartz that's going to be 6,000, So people tend to over improve on flips as well.
Yeah, I completely agree. And I think for anybody who wants to get started, I would 100% recommend doing your first one as a rental. Really, the only reason I'm doing flips now is because I just come across the opportunity and there's, kind of like I said earlier, good profit margin. And I just really see it as a vehicle to be able to reinvest it back into the business and then scale my rental portfolio even bigger, just with having that extra capital reserve. Whereas when you're doing your first rental, it's a much lower risk, because you're still learning how to manage all of these projects, how to manage contractors, how to deal with contractors. And if you're doing a flip, chances are you might have to take out, if it's in the city, all of the plaster in the house, do a brand new electrical rewire, all new plumbing, a new roof, whatever it might be, where it's going to be a much bigger project. And if you've never managed construction or managed a property before, it's going to be super overwhelming, and you're going to be up all night being like, man, did I make the right decision? What am I doing? I'm over my head. So I definitely recommend doing your first rental. And kind of the sweet spot that I found is that if you can find a rental where the after rehab value will be between 125,000 and 160 to 175,000, those properties tend to cash flow very well, just with what the payment will be and what you can get in for. Because a lot of mine are like all of the appraisals usually are somewhere between 125 and 175. So it's a very good sweet spot to be if you're doing single families. And multifamilies are a whole different, story, but you can literally use the exact same formula, with a duplex, with a four family. And there's even people, and I'm not to this level yet, that do this exact same formula, with a 30 unit apartment complex or a 100 unit apartment complex. The only thing that changes is the structuring of the financing, but all the other concepts are exactly the same.
And yeah, that's awesome. And Brittany asked too, are there restrictions on areas for Section 8? The answer to that is no, but it does with Section 8, they put a limit on what they pay for like 1 bedroom, 2 bedroom, 3 bedroom. So certain areas just won't make sense. If I had a 3 bedroom house in Ladue that I paid $1 million for, I wouldn't be able to get enough income or enough rent from the housing authority to justify that purchase price, if that makes sense. So it's dependent on they're going to cap the amount of income or rent they're going to give you on the number of bedrooms. So certain areas just don't make sense financially if the price point's extremely high. I like areas up like 63136 zip codes like that. I own a lot of stuff in 63118 in the city. A lot of those zip codes make more sense from a return perspective on utilizing Section 8. Delwood was one. Yeah, Delwood's a good area too.
They actually
That
made rentals recently, so don't buy in Delwood if you're going to do a rental.
what is it? What happened?
Delwood, they banned rentals.
Oh, did they? Because there's the other one too by the airport. What's the other area where they banned
It
them?
was Berkeley. Berkeley had them
Berkeley.
banned for a while, but they actually lifted that. So now you can rent there, but they're very particular about what they want in their tenants and
Yeah.
property to look like. So that's the other good thing to pay attention to too, is some municipalities will make you jump through a lot more hoops than other municipalities. I know for a fact that most of St. Louis City is very easygoing when it comes to occupancy inspections, and even most permits are very easy to deal with typically, as opposed to if you go in St. Louis County, they can be a lot stricter, especially in some parts of North County. There's some very, very restrictive municipalities that it's good to know about that before buying a house, because that's something that can, automatically throw your time frame or your projected finish time off by, 2 weeks, 3 weeks, even months if you don't know what you're getting into.
Yeah. Good call. Yeah. And then Lisa asked, does Section 8 work the same as in the past? Fill out a form, they schedule an inspection. Yeah, so there's the housing authority has inspections that it's kind of like an occupancy, and they'll come out, you fill out all the paperwork, they'll set the rent rate. You give them a rent of what you want, and they may negotiate it or may give you that rent rate as well. So yeah, very similar. It's the same way. Yeah, that it's been filling out paperwork and getting in there. Kimyetta says it's good to connect with property managers who have Section 8 tenants. Yeah, for sure. That's a great call. Yeah. Link it up. So, Joe, that's a good point, Kimyetta. Joe, are you managing yours yourself? Or
Yes,
you're a property
I,
manager?
I would highly recommend managing yourself, especially when you're like very new. Kind of the same way as managing maybe one or two projects when you're new with the contractors, just because when you have property managers, there's very few good ones out there. And sometimes you'll be paying, like most of your cash flow will be going out the window. So then you'll just have this house that's being managed and you might not have to worry about it, but not all property managers are that great. So you're still paying them, a fee. And then sometimes they'll just tell you when there's a problem and you still have to deal with that problem. So I would highly recommend self-managing your properties. It sounds like a lot of work and it's not that bad. I mean, you'll have certain seasons or certain times where you'll have multiple problems you're dealing with at once. But by nature, being a realtor, that's what our job is, to deal with problems. So it's not the end of the world, but there's some great portals out there. Personally, I use something called Rent Ready, where you can basically set up all of your tenants in a portal. That's where they pay their rent. That's where they make any maintenance request or repair request. That way, it's all through one portal. And I recommend not giving them your direct cell phone number, so then that way they can't call you and blow you up in all hours of the night. And then you also want to kind of position yourself like you're the property manager and not the owner, because then people, say it's, the 15th and they haven't paid their rent on the first, they might say, oh, I know Joe's the owner. He'll work with me. But if you position yourself like you're the property manager, and it's very less emotional, then you're just being like, I'm the manager. The owner wanted me to come out here today, or the owner wanted me to reach out to you and say, hey, when are you going to pay the rent? So then basically they don't think they're going to be able to pull at your heartstrings. So there's some psychological, perspectives to take to it. But I think self-managing is definitely the way to go until you get to a large amount of units where it's just unbearable.
Can we touch on that? I hate to wrap up with like the ugly, but like, like there's all these coaches out there and people selling programs and like they make real estate investing look so easy, like there's never problems, like it all just happens. And we know that's not the truth. Like, and so I think it's important to touch on that as well. Like what bad experiences have you had so far doing this, Joe?
So I've had on my flip, I had a project get delayed by like 2, 3 months because of an occupancy inspector wanting certain things redone and finding new things and just really being difficult to work with. So that's one. So on a flip, that's something to, and I learned a lot from that too, is just being able to kind of get ahead of that. So then that way you're already prepped before they come in and they don't cause any delays with you. And then on the rental side, like I said, I had an eviction recently. So definitely screening your tenants is a huge lesson I learned. Like making sure that just because they send you their pay stubs or just because they, say they lived at this place, make sure you double verify everything. Like if they say they work at, McDonald's or they work at a certain hospital or wherever, make sure you actually like pick up the phone, call their employer and be like, hey, I just want to verify that, Michael works here or whoever it is. So then that way, because people will lie all the time, and there's people out there, unfortunately, that tend to play the system because they know that tenants have a legal right and you have to formally go through the, eviction process. You can't just show up at the house with a baseball bat and tell them to get out. You have to, go through the court, unfortunately, in some cases, and wait for them to, do the eviction proceedings. So it's super important, even if it, pushes you renting that property out 2 weeks or 3 weeks. I'd rather have that delay and have a super good tenant than have a tenant that I'm going to have to evict in 2 months and then I'm going to have to, pay holding costs for the next 3 months and then clean the property out, paint it, do whatever. And I think it's also important to make sure you have your systems and your contractors down because you'll have those really bad experiences where, like I just had the tenant, he left all of his things behind. His dog pooped and peed all over the basement. And it's overwhelming. But then if you have good contacts, I have some great contacts where I was able to get that property cleared out within 2 days, get the entire house painted, get everything fixed up, looks like it's moving ready in less than 2 weeks, and I already have a tenant moving in this Friday. So it's important to be like strategic about things because you're almost playing like chess in some aspects. So you just have to realize that bad things are going to happen. It's not going to be all sunshine and rainbow HGTV, rich dad poor dad, where I'm going to be a millionaire in 2 weeks. It's going to be hard. It's just, I think what I've learned too is that the people who own a lot of real estate, they're just very good at dealing with problems and very good at stomaching the problems and not just saying, oh, this tenant moved out, I'm going to sell this property. It's all about how long can you hold it and get it to cash flow, and that's where the real wealth is built.
Yeah, that's a good point. And I think I'll just add on to that. The only time I ever got been burned is when I rushed to put a tenant in. When I didn't screen them, I didn't do my due diligence. I just wanted to place a tenant. And then it ended up not working out. So I think to your point, if you do your due diligence, you vet your tenants correctly, you check on references, things like that, you tend to attract good tenants that might stay with you long term. So just keep that in mind. And then Leanna asked you, what platform did you say for property management? Rent Ready? You're muted, Joe. You're muted.
Yeah, I was gonna say it's called Rent Ready, but it has an I at the end instead of a Y, so it's Rent REDI.
Rent Ready. Yeah. What area had the long occupancy inspection wait?
It was in Tower Grove South.
Okay. City. Yeah. Unfortunate. Some of those city inspectors walk in and just approve you, and some don't.
So that's one thing I've also started to kind of notice with the city of St. Louis, at least, is depending on the area and the price point, some areas they're very strict in, like Tower Grove being just the price point in the neighborhood. Other areas they're not as strict just because the average price point's lower, or the area isn't as desirable for some people. So that's something to consider too when you're looking at properties on how strict is this occupancy inspector going to be? How easy is it going to be to pass these inspections as well?
Yeah, I had an occupancy. I did a flip a number of years ago, a three-story historic home in the city, and the inspector was winded walking up the 5 stairs from the outside, and she could barely breathe. And then she walked to the main floor, and then she looked upstairs, like literally looked at the stairs and saw there was two more flights, and she goes, "Does the rest of the house look as nice as this?" I said, "Yeah." She said, "Okay," and she approved it. So she was not going to tackle those next two flights of stairs. So yeah, you just never know. All right. Uh, so no, this is really good today, Joe. I appreciate you being on to share this information. So getting financing in order, can people reach out to you and get contacts from you
Yeah, I
for
was gonna say
financing?
I'll drop my number in the chat right now. And if anybody's interested in kind of getting an introduction or finding certain lenders, feel free to shoot me a text. And I'm happy to connect you with them. Just because I think this is an opportunity that everybody in Network Global should be taking advantage of. Because not only will it help us build wealth, together, and then we'll all learn from each other. But at the same time, we'll also be able to have a lot more tools on our tool belt to help our clients and actually grow our real estate businesses. So I think if this is something you've been on the side, and that's how I was, I've been on the sidelines for a long time, kind of hesitant to like, do I want to do this? Do I not want to do this? So I think just take the leap of faith, and get into it and do your first one, and then you'll learn a lot and then just build from there.
Yeah, and your point here, Joe, start small, but start now. I think super important to, yes, not take on projects that need a ton of work out of the gate. So I would rather pay more for a property, a little bit more, that doesn't need as much work than take something on that's going to need, like, I have to gut the bathroom, gut the kitchens, rip out the ceilings, and do this full scale renovation. When I was buying, I don't buy many rentals now, but when I was looking for stuff that I could turn within a couple weeks and get a tenant in place. Go in, run carpet in there, run some new flooring, paint the property, update the bathroom quickly, like simple things like that that we could get done fast where it wasn't going to take months and months and months of my time. Same thing with flips. When I used to flip a lot of houses back in the day, I started really small with smaller flips, and then graduated and worked my way up to these full scale renovations where we were demoing everything. But they were such a pain in the butt, and we were on those. I had one project that took a year. It was a big 6,000 square foot, two townhomes, and it was like full gut rehab. It was expensive too. Went way over budget, spent way more time on it than I thought. So starting small is a great call with finding stuff that doesn't need a lot of work that you can get in and out of quickly, vet your tenant, get your tenant placed, or if you're doing the flip, find stuff that's got enough spread built in there where you don't have to be on the, like gut the whole property. Find stuff that needs more minimal work. Your last flip, Joe, that one that you just put on the market, how long did that take?
So I closed in April and we just listed it like
Okay, so yeah, what, 8 months? Is that right?
and the goal is to have it listed by July. So that just goes to show that flips take very long time. And I've yet to have a rental go over the time frame. I mean, I have a four family right now. It's a huge project, had fire damage on it. But got it for a very good price and had a good spread on it. But I have yet to have a rental that has gone over 6 months. So that's something to think about as well.
Yeah, so your rentals, you're placing them faster. Yeah. I mean, that one you went, what, 4 months over your time? You thought you were going to get done in July,
4 months. So like
5 months.
the costs are way more. You have to
Mhm.
talk to because like some of the hard money lenders will do 6 months, some of them will do 12 months. So you have to have that conversation with your lender that like, hey, I need an extension because that's scary when you're like, I don't know if they're going to give me an extension or they're just going to want the keys back and the house back. So that's the other important thing too is to if you have a hard money lender or a private lender, make sure you communicate regularly with them and build that relationship up. So then that way when you do run into issues they know that you're putting in the effort, you're putting in the work. You're not just, sitting there, hoping and praying that something will happen. You're actually communicating with them and showing them that, like, hey, I'm making progress. I have these problems. I'm working through them and I'm going to get to the finish line.
Yeah, that's awesome. And I think too, Melanie asked too, is it a good deal to get a seller finance deal off the MLS that already has a tenant? Depends, right? It depends on the numbers, really, Melanie. So it depends on the numbers of would you agree with that, Joe? I mean, it depends on if the numbers make sense.
Yeah, I would 100% agree. And I mean, the reason I like to do the Burr so much is because they're all value add properties where you're basically creating equity with somebody else's money and then you're paying them off once you do the refinance. So that's why I like this method of investing so much because you're creating value and you're creating equity. Whereas with the seller financing, they can be great, but in some cases, those properties might already be at the top of the level for equity. And then sometimes you have to come up with a large lump sum of cash on the seller financing, but there can be great deals from them.
Mhm. Have you borrowed against any of your properties? Pulled out your equity?
Yep. So that's one thing I was going to add too, is that once you finish the hard money loan and you refinance, if you go the DSCR route, some of the lenders will allow you to do a cash out refinance when you refinance and there's no seasoning period. So you could have a property done in 3 months from when you bought it and you can refinance the house and you can pull sometimes 20, 30, $40,000 out. I even know someone who's probably made like six figures this year just from doing that strategy. So you either have the option to keep the equity in the deal or you can pull it out. And if you pull it out, the goal obviously is to redeploy it and grow this at scale.
And the nice thing about that, what he just talked about there, is when you pull that, when you borrow against those properties, one, your tenant's paying down the equity then. So let's just say you had you borrowed $30,000 in equity against the property, your tenant's paying that because they're paying you rent. So they're paying that off. The nicest part about that too is that 30 grand that you just got is tax free because it's a loan. So you don't pay income tax on that. And so that's where maybe we could have another training at some point, Joe, where we talk about borrowing against our equity and pulling out. Because it's a great way to utilize and get money tax free, which is, in my opinion, the best money.
For sure, because I've had a couple deals where I've been able to pull out like 15, $30,000. And that can be super helpful to be able to really, deploy money out and keep growing this at scale and not having to use my own earned income as much.
Yeah, exactly. Sweet. Yeah, we'll get another training on that and talk more on that part of it. So,
Perfect.
Joe's information is in the chat as well. I appreciate you sharing that as well, Joe, with your information. So feel free to reach out. I've known Joe a long time. He's a great guy, super smart guy, and he's building a real nice business. So it's pretty awesome to see, and a great mustache. Um, so yeah, I appreciate you being on though, Joe, very much. And yeah, we'll get another training on the books. But thank you for taking your time today. This is super informative, super helpful. And if anybody has questions, reach out. Thanks for being on, and we'll see you all very soon.
For sure. And I
Thank
was going to
you.
add
Thank
too,
you,
if
Joe.
anybody who wants to walk a property or a project, feel free to text me. I walk my properties a lot, so I'm always happy to have you meet me out there and just talk things out so you can learn.
Yeah, I think that's awesome, Joe. That's a great
Cool.
offering right
Thank
there.
you.
Yeah, I would take him up on that, everybody. It's you'll get to see it firsthand and learn a lot. So that's awesome.
So I appreciate everybody getting on.
Yeah.
Thank
Thank
you.
you.
Thank you.
Have a good day.
Thanks,
So,
everybody.
Thank you.